Today I'm going to talk about the supply and demand for currencies. And when discussing this, I'm going to compare it to our regular supply and demand curve that we have here on the right and show you how it's very similar to supply and demand for currency. In this example here, we're going to use the regular product of, here in this case, Red Bull. And as you may recall, we have an upward sloping supply curve, and we'll have a downward sloping demand curve with an equilibrium price, and in this case we'll say that that price is 300 yen. And as you may recall, this will be our supply. And this would be our demand. As you may recall, there's an inverse relationship. As the price of the Red Bull goes up, the quantity supplied will increase, because at 400, the company Red Bull rather provide more Red Bull than at 300, and below 300 they want to provide less. So there's that direct relationship. As the price goes up, they'll supply more. For consumers, though, as the price goes up, they'll buy less. So if Red Bull's at 400, remember, they'll want to supply a lot more. Consumers will want a lot less. And so therefore, it'll be a surplus, and below 300, there'll be a shortage. What we don't often say here is actually the price here of 300 yen is per Red Bull for each Red Bull. So when we say the price, it's always per Red Bull. And the quantity, of course, here is of Red Bull. You can use the same concept when we talk about currencies. Again, we'll have a similar supply. And demand curves that have the exact same attributes. Label these. This will be supply, and I don't know why the box is so big. And down here will be demand. Okay, so in this case we'll also put down a price will be 100 yen per dollar. And again, it's always per $1. So let me put a text box here. So exchange rate at this equilibrium here, and I'll put a point here for the equilibrium. At this equilibrium, it's 100 yen per dollar. Who is supplying and who is demanding in this case? Well, given that it's dollars, the Americans would be supplying, and they're willing to supply more dollars to the market to exchange for yen if they can get more yen per dollar. And conversely, if they could only get, say in this case, 50 yen per dollar, they're not going to supply as much. Who is demanding? Here would be the Japanese. And so in this case, at a higher yen per dollar, they don't want as much. And at a lower yen per dollar, they want more. And so the equilibrium rate here will be 100 yen per dollar. So notice here, you have a similar situation as you had with the products over here. So what will cause the exchange rates to change? Well, just like in the product market, if there is an increase in demand for Red Bull, let's say, what happens is there's a shift in the demand curve, and there is a new equilibrium, which would be at a higher price. So let's say this would be at 400. So again, it'd be 400 yen per Red Bull on a new equilibrium. Same thing happens in supply and demand for currencies. If there's more demand, that is, if the Japanese, who are in this case demanding the dollars, want more American goods, that would be increasing, or there's more of them coming to America for on tour, things of that sort, anything that would increase the demand for dollars. Maybe our interest rates went up. Our government bonds are paying a higher interest rate. They'll demand more of our bonds, and therefore they will demand more dollars to purchase those bonds. And so then again, you'd have a new demand curve with a new equilibrium. And in this case, maybe it's going to be, instead of 100 yen per dollar, maybe 120 yen per dollar. So the same concepts that have been going on with supply and demand for products happen also with supply and demand for currencies. So again, you can use a shifting of supply, you can use a shifting of demand, and a new equilibrium will tell you exactly what happens to the exchange rate, and in this case, the exchange rate would be the yen per dollar. I hope this short little tutorial helps in explaining the concepts of exchange rates. Please contact me more if you have more questions.